Hi, Larry Gaines, PowerCycleTrading.com. So one of the great things about trading options is that you get so much flexibility and so many things that you can do as far as adjusting from one particular type of option strategy to another to enhance and make greater profits or reduce your risk. So in this video, I want to show you how to take and use a calendar diagonal spread and then adjust it or convert it to a long call butterfly. So by doing this, we're going to create a trade that has tremendous upside with very little risk, or a lot of times we can adjust this trade to make it where there's no risk and you're actually going to receive a credit for the trade. So the first step in this trade is to do it as a calendar diagonal spread. So we're going to be looking at Microsoft in this example. So a calendar diagonal spread, the benefits is what it benefits from is the rate of time decay between your long dated option, which expires further out in time, and your short dated option, which is closer in, which is going to have a lot greater theta decay or time decay. So basically we'll be selling time. And then the other advantage is if we have a positive horizontal skew where the implied volatility is greater in the front part of the option series, we get that advantage too. So this is two great advantages, but the other benefit is that it has a spread vertical spread component, which adds a greater probability or profitability for, if you're correcting your speculation as far as the directional move up or down. So it's kind of like sometimes referred to as a poor man's covered call. So instead of buying the shares of a stock and then selling calls against it or puts against it, we're going to buy the options further out in time and then sell options against that closer in. So in essence, we're buying options at a discount, and this is a net debit trade when you start out. So your risk is defined as a debit. So this is the first step in this trade example I'm going to show you, and then we're going to convert this to a call butterfly for potential huge upside potential. So let's take a look at the option chain and series, and I'll walk you through it. So first off, this is Microsoft, and it had a really nice move today. Now you can see here, today is the 4th of November. And so Microsoft gave us a long signal here today based on my trading model. And we came from a swing high up here at 225 to this low of 200. And now we're back through the 618 at 215. Now we've got a really strong target right here at $220. So there's a lot of option activity there. And so also this is a Fibonacci level. So what I want to do in this trade, I was trying to figure out a way, how can I set up a trade to go towards 220? And I want to set up a potential butterfly for monthly expiration, which would be the 20 November series. So it would go out at 220, but there's potential that it could go greater than 220. So I want to be able to capitalize that in case it does. But if it doesn't, it holds here under, I can convert it to a butterfly and really make a huge profit on zero risk or a credit. All right, so let's take a look at the first step. That's a calendar diagonal. So step one in this trade, we're going to set up a calendar diagonal. So we want to target 220 right there. So we're going to come out, we're going to go to the 20 November series, 16 days from expiration, and we're going to look to buy the 215 call right here. All right, so we're going to pay about 250 or 260 to buy that long 215 strike there, and that's the 20 November. So we're going to buy that, and then we're going to sell the 13 November where my pointer is. We're going to sell the 220 call against it and bring in about 265 or 270. So it ends up being a spread where we're long the 215 in the 20 series, and we're short the 220 here in the closer in. Now we're going to take advantage of theta. See my pointer here? The 220 short strike here that will be short has a theta decay of 20 cents, and the 215 that will be long has a theta decay of 16. So we're going to get $4 a day from theta decay, and that's going to help the trade perform. So let's take a look at what this looks like. Okay, again, buying the 215 20 November, then selling the 220 against it on the 13 November. So we can buy that 20 November 215 call for $6.55. So $655 for one option contract. And then at the same time, we're going to sell the 13 November 2020 against it and bring in $277 credit. So the first step is this profile here of a calendar diagonal, and the total risk is your spread width of your debit cost of the 655 minus 277. So your total trading risk on this is a calendar diagonal for a total of $3.70 $3.78 or $378. So here's where it works really great. So let's say, for example, on Friday, this exploded to the upside and it's trading at 220. Well, at that point in time, we'll be up $56. So if we wanted to, we could take profit at 56. Now, if it doesn't and it keeps going, and then next week is the expiration and it goes to the 13th and it goes out at 220, we would be up at about $280. But if it closes below the short strike here of 220, we're going to keep that full credit of $277, and then that will adjust down the long dated, the 215, by that amount. So that would then put the 215 call at a price of $378, and that's where we then convert it to the butterfly. Okay, so the next step is to convert it. So if we get into next week, coming into the November the 13th on Friday, and Microsoft is trading below our short strike here of 220, we can let this expire worthless. We'll keep that full 277. That adjusts down the price of the long dated, the 20 November 215, to a price of $3.78 or $378. So then the next thing is we sell immediately on that Friday. We'll go out and we'll sell the 20 November 220 call against it. Creates a call debit spread right here, and the risk would be if we'd use these prices here, the adjusted price of the 215 at 378, less where this is trading next Friday, the 220. So let's say it's at 375. This trade would have a risk of just $3 on the call debit spread side. But the other thing we can do, which really makes it cool, there's a lot of option activity at 220, so I think there's a good chance it can go out in what we call pin, so expire at 220. We can convert it to a butterfly targeting that 220 by just selling a bear call credit spread, the 220 November series 220.25 bear call credit spread. In this example, bringing a $1.80 credit or 180. So now we've converted this trade to a butterfly targeting 220 for expiration on the 20th of November, and the trade would be up $177 credit on if it goes down, you make $177. It goes up, you make $177. If it goes out at 220, you'll make over $600. So, these numbers will be accordingly different based on where it is in time, but that's the basic concept of how to take a certain option strategy as a calendar diagonal and then adjust it to enhance it to make it even a bigger potential payoff. So if you like this video and you'd like to learn more about these different option strategies, make sure to join us at PowerCycleTrading.com. Good luck trading.